Hey everybody, my name is Cade, Bekanich, certified financial planner and owner of Park Lane Financial Group. And the most versatile type of account that you can have for your overall financial plan is a taxable brokerage account. So let's get into it. First, let's define a taxable brokerage account. A taxable brokerage account is the type of investment account that you open up with the custodians that you guys have all heard of: Robinhood, Charles Schwab, Fidelity Investments, Vanguard, whatever it might be. And I'm not necessarily partial to one of them, although I will tell you that we operate on Charles Schwab for our platform. That being said, doesn't matter, totally your opinion, and that was not financial advice. Let's get back to it. A taxable brokerage account is an account that the funds that have been contributed to that account have already been taxed, which means that when you take money out of the account, you're going to pay tax only on the gains of the investments that you've made. So here's an example. If you put $100 into an account, no matter what you buy, and that account grows to $110, let's say you take it out in less than 365 days, because from a tax consequence perspective, there are different options. That being said, $100 grows to $110. If you take it out in less than a year, you're going to be subject to short-term capital gains taxes on that $10, meaning you're not going to pay tax on $110, but only that $10 portion of $110. So how does that impact your overall financial plan? And what do I mean by saying a taxable brokerage account is the most versatile account? Well, first of all, because of the status of these assets, meaning post-tax, you've already paid tax on the money that goes into that account, there are so many other ways to use it than simple investing. First of all, these accounts offer the opportunity to use them as leverage, meaning you could trade on margin, which essentially is a very, very risky way to take the money that you have and trade it on a multiple. So for example, if you have $100,000 in an account, a custodian, one that we spoke about, might offer you the opportunity to trade on 120, 150, or even 200% of the value of that account. Certainly do not recommend that. It is not financial advice. It's not something that I do personally, and it is absolutely not something that I do for my clients, but it is an option. And for people who are considered to be professional traders, it's a great way to maximize the overall investment return that you have, especially if you're starting off with we'll just say an unsubstantial amount of money. Number two is collateral. You can actually use these types of accounts as collateral when applying for a loan. So the lending institution, whether that be a bank or a brokerage firm, will take these assets into consideration as something that you're able to use to pay them back in the event that you will default on a loan. So whether that be an auto loan, a mortgage, or a personal loan, having these assets on the side will be able to give you a much greater advantage to get a better rate as well as a more favorable loan term, simply because the bank already knows that you have a certain amount of money set aside in the event that you aren't able to pay your debt. Whereas for reference, banks will not take into consideration a retirement account. They may look at it on your overall balance sheet, but I know for sure that you're not able to use a retirement account as collateral to qualify for a loan, which of course emphasizes the importance of saving money outside of your 401k. Here's a side note. Just as previous generations thought that Social Security would be enough to fund their retirement today, our generation and people that are currently working are anticipating Social Security and 401k contributions to be enough to pay for retirement, but inflation is real, life is expensive. I highly recommend that you save money outside of both your 401k and other savings accounts, possibly investment accounts, to help fund your long-term intentions. Number three is tax planning. Of course, you guys hear me say it in almost every single video because it's one of my favorite parts about financial planning is how do I manage my investments and make the most of my money by paying the least amount of taxes? Well, here's a great example. When you have a taxable brokerage account, the one that we're talking about now, and a retirement account together, if you need to take money out of accounts during retirement, it might be a great idea, and of course I said might, so something that you should consult your accountant and financial planner about, but it might be a great way to save on taxes because again, the money that's been contributed to your taxable brokerage account has already been paid tax on except for the gain portion, whereas money that's coming out of a 401k, an IRA, or other retirement account is subject to complete and total income tax. In other words, every single dollar that comes out of these accounts, you're going to have to pay tax on them. So if you need to take out $10,000 in retirement and you have the opportunity to take money from a taxable account or an IRA, of course, it depends on your overall situation, but it's likely that your tax liability is going to be much lower by taking $10,000 out of a taxable account than it would be according to your IRA. As a matter of fact, I think it's actually impossible that it wouldn't be the other way around. That being said, don't be afraid to use these taxable accounts in order to fund whatever it is that you need to, whether it be retirement or otherwise, simply by looking at your initial basis, meaning how much you've paid for investments versus how much they've grown to, and of course, how long you've held those assets, because don't forget, there is a difference between short-term capital gains tax rates and long-term capital gains tax rates. Long-term capital gains tax rates are subject to investments that have been held for greater than a year, which are more favorable rates, and short-term capital gains tax rates are on investments that have been held for a year or less, which of course are less favorable. And on top of talking about distributions and helping to fund retirement, let's talk about something something a little bit more practical for younger people, or even people in retirement that continue to work: tax loss harvesting. When you have a loss on a taxable brokerage account, you're actually able to deduct a portion of that loss, at least up to a certain extent, against other income for that year. So for example, if you have an asset in a taxable account, let's say you bought Apple, for example. If at the time that you bought Apple, it was at price X, and when you sold it, you actually had a $3,000 loss, you could take that $3,000 loss and use that to offset other income, meaning that's $3,000 less of income that you're going to have to pay taxes on, which again is a great way to clear up assets, sell off stocks that you're really not too keen on holding anymore, or simply just a way to take money back out of your account because you need it for whatever reason and not have to pay tax on it. Or again, at least to keep your taxes low depending on the dollar amount. And again, as always, something you should revisit with your account. And number 4 is gifting and charitable contributions. So when you make a gift to somebody, your basis, or the amount that you paid for it, is actually transferred to the person that you're giving the gift to. So for example, if you paid $1,000 for a stock, and at the time that you gift it to your family, friend, grandson, whoever it might be, it's worth $10,000, their basis is $1,000. It's the same dollar amount that you paid for the initial investment. That being said, whoever gets this asset, even though it's a great contribution, a great gift, and a great opportunity for them moving forward, will have to pay tax on the difference between what you paid and what the value of the account is today if they sell it. The next half of that is charitable contributions. When you're looking to make a charitable contribution, whether it be to a nonprofit, a church, whoever it might be that you're choosing to bequeath this gift to, this is a great way to keep your taxes low and contribute an amazing sum of money, whether that be $100 or $100 million. Of course, it depends on your own circumstances. It's an amazing way to give these generous gifts without being subject to major taxes. So ask your accountant and ask your financial planner about different ways that you can gift appreciated stock or other assets to your favorite charitable organizations, your nonprofits, your churches, whoever that may be, and using it as a tax advantage to yourself, as well as being able to get highly appreciated assets out of your estate. Sometimes this is used as an estate planning technique, sometimes it's simply used as a tax planning strategy, and sometimes it's out of pure generosity. But whatever your intentions might be, this can be a great way to save yourself some money, to save your family some money, and give your favorite nonprofits and charitable organizations a major asset without being subject to a ton of taxes. So as you have questions, as you move along with your personal tax planning situation, your estate planning situation, and transition from your earning years into your retirement, we would love the opportunity to help you. We're always so grateful that you take the time to watch these videos, to educate yourself, and to learn about why financial planning truly is the basis of building long-term wealth. So that means you click the link in the description below today to schedule your first meeting with us. I'm Cade Bekanich, certified financial planner and owner of Park Lane Financial Group. Thank you guys for watching, and we'll see you in the next one.